You know, if you really dig into the raw data right now, like the historical market trends, it looks like the next 10 years might actually be the last major window for, well, outsized wealth creation.
Yeah, a closing window. After around 2034, that era of making 10 or 50 times your money on a single investment might just be permanently shut down by uh, basically demographic gravity.
Hello, everyone. You are watching Smart Capital, the School of Financial Literacy. Today, we are unpacking a pretty startling financial argument.
We really are. We're doing a deep dive into this massive stack of recent macroeconomic data, historical charts, tech sector numbers, all to understand why the rules of wealth building are totally shifting beneath our feet.
Right. And before we continue, I'm curious how many of you are already interested in financial education or investing. Let us know in the comments.
It's so important to figure out where you stand today because honestly, the passive set it and forget it strategies that worked so brilliantly from like 2010 to 2020, they just aren't built for the reality of 2024 to 2034.
Not at all. And it's a really bold premise, right? But it's not based on doomsday pessimism or anything.
No, not at all. It's actually just about this really unique historical clustering of conditions, basically watching a massive collision right now
A collision between what exactly?
between explosive, totally unprecedented technological growth on one side and these immovable, heavy macroeconomic walls on the other.
Wow. Okay, so to really understand this transition, I guess we need to map out the causality.
Exactly. We need to look at the explosive growth first, then why the broader economy is actively fighting against that growth. And then, most importantly, we'll break down three specific ETF strategies to help you actually navigate this exact collision.
Okay, so let's start with the bright side, the explosion of growth. Because the data points to the fact that we're currently sitting at the front edge of multiple exponential technological curves.
Right, which is wild. Usually, historically speaking, we see one major technology, like the personal computer or the smartphone, kind of carry the whole market.
Yeah, just one big thing at a time.
Exactly. But right now, we're seeing several massive world-changing technological shifts happening completely simultaneously.
So, to understand how this actually translates to wealth, we really have to talk about the mechanics of the S curve, right?
Yes, the S-curve is everything. When any new disruptive technology drops, its adoption is initially super flat and very slow. That's the bottom tail of the S.
Like people are tinkering with it, but it hasn't scaled yet.
Right. But then it hits this critical inflection point. The cost drops, the utility just skyrockets, and adoption goes nearly vertical. That's the steep middle part of the S.
And then eventually it matures, right? Market saturation hits and the growth just kind of flattens out at the top.
Exactly. Top of the S curve.
I always think of the S curve like discovering an indie band.
Oh, that's a great analogy.
Right. If you find them when they're playing dive bars to like 50 people and you invest your time in them, you get the thrill of that massive upward trajectory when they suddenly blow up.
You capture those massive 10 to 50x returns.
Yeah. Think of investing in Nvidia back in 2016 or 2017 when they were just making graphics cards for gamers. But once that band is selling out global stadium tours,
Well, the explosive growth phase is over.
exactly. Everyone already knows they're great. You aren't getting in on the ground floor anymore.
That is a perfect visualization. The largest percentage gains in any market always happen in that early adoption phase,
Mm.
long before the broad awareness hits.
Before valuations totally saturate?
Right. Because once a technology's dominance is obvious to the mainstream, the returns just compress. You're paying a premium for certainty at that point.
And what makes this decade so crazy is that we aren't just riding one S curve. I mean, AI is the loudest one, sure, but it's not the only one.
Not even close.
Yeah.
If you look at the data, we're also talking about the massive energy transition, the global grid rebuild.
Oh, yeah, we need just unprecedented amounts of copper and new transmission infrastructure just to keep these new data centers running.
Exactly. And then you have biotechnology. Things like CRISPR and mRNA are moving from, lab theories to actual commercial therapeutics, plus the privatization of space, satellite networks,
All of these sectors are hitting that vertical inflection point at the exact same time. It's crazy.
which creates a fascinating ripple effect in the market.
If you enjoy clear and simple explanations of financial topics like this, give this video a like so we know you want more content like this. So, okay, we have these incredible tech advancements, but how does that actually look in the stock market?
Well, it's not lifting all boats equally, that's for sure. It's creating a historically top-heavy environment. We are currently at multi-decade highs for market concentration.
Right, the concentration is insane.
If we look at these so-called magnificent 7 tech stocks, Apple, Microsoft, Alphabet, Amazon, Meta, Nvidia, and Tesla, they collectively make up over a third of the entire US stock market by market.
7 companies. Let that sink in for a second. Over a third of the market value driven by 7 companies.
Yeah. And if you expand that just a tiny bit, the top 10 stocks account for roughly 29 to 38% of the total market capitalization.
It's basically like a high school group project, right? 2 kids are doing absolutely all the work, and the other 498 kids in the class are just coasting on their grade.
You'd hit the nail on the head. And the mechanics of why they dominate are so important to grasp. These mega cap companies have cash reserves larger than the GDP of entire countries.
It's hard to even fathom that kind of money.
They have the monopoly power to just buy up any emerging threats and the capital to build the multi-billion-dollar data centers required to train the next generation of AI.
They've essentially built these impenetrable moats around their S curves. So, if I'm hearing you correctly, sitting in a broad based equal weight portfolio right now is essentially betting on the 490 lagging companies.
Right. Rather than the 10 that are pulling all the weight.
So, if you expect a rising tide to lift all boats, you're totally ignoring the fact that a few boats have turned into massive dreadnoughts, while the rest are, well, taking on water.
Exactly. And historically, the data reveals that periods of extreme index concentration like this usually precede flatter returns for the broader traditional indices. The overall market performance is just increasingly reliant on a very small, concentrated set of massive winners.
But this brings us to the really profound tension in the data we're looking at. If technology is booming in such an unprecedented way, and these massive companies are printing money,
Why is this a closing window of opportunity?
right? Why isn't this just the dawn of some open ended golden age for everyday investors?
Because the foundational macroeconomic rules that govern the other 90% of the economy are fundamentally shifting against us. This is the collision I mentioned earlier.
Ah, okay. The technological tailwinds are smashing directly into these macroeconomic brick walls.
Yes. Imagine you were in this situation. What decision would you make? Write your thoughts in the comments. I mean, if you knew your overall long-term income growth was going to slow down permanently, how would you change your saving or investing habits today?
I'd probably get a lot more aggressive with where I put my money.
Right. And that is the exact dilemma facing the global economy right now. The first major macroeconomic wall is demographics.
Right, the aging population.
Yeah. For the past several decades, the stock market had the wind at its back. We had massive growing workforces entering their prime productive years, rising worker productivity, and rapidly expanding globalization, lowering the cost of goods.
Everything was cheap and everyone was working.
Exactly. But now we are entering an era of aging populations, shrinking labor forces, and much higher dependency ratios.
Let's actually clarify that term because it's crucial. Dependency ratios. Meaning a shrinking pool of working age people is now mathematically forced to support a massive growing pool of retirees.
Yes.
But why does that specifically hurt stock returns?
It comes down to the mechanics of consumption and capital formation. Basically, different age cohorts consume entirely differently.
Okay, so like a 30-year-old versus a 75-year-old.
Exactly. A 30-year-old is highly consumptive. They're buying their first house, filling it with appliances, buying cars, paying for childcare. They are spending rapidly.
And usually taking on a ton of debt to do it, right?
Oh, absolutely.
Right.
Which aggressively drives corporate earnings. But a 75-year-old is doing the exact opposite. They are downsizing, preserving their capital, and spending mostly on healthcare and services.
And since a nation's gross domestic product GDP is ultimately driven by consumer spending and labor supply, having fewer young workers and way more retirees just means slower overall GDP growth.
You've got it. And slower GDP growth mathematically dictates slower overall corporate earnings growth across the broader market. Demographics are destiny, as they say.
Wow, so demographic headwinds don't just cause the markets to crash overnight. It's not a sudden thing.
No, it is much more insidious than that. They act like gravity. They just slowly reduce the magnitude of broad economic gains year after year.
Just dragging it down.
Right. And right now, that demographic gravity is being violently compounded by a second wall, the absolute end of the easy money era.
Oh, man. The 2010s. That decade was defined by zero interest rate policy. It just felt like free money was everywhere.
It really was.
You could have a tech startup with zero revenue, literally just a compelling napkin sketch, and secure billions in venture funding simply because the cost to borrow money was effectively zero.
And that ultra-low interest rate environment fundamentally distorted asset prices. It made both stocks and bonds soar.
Because equity valuations and interest rates move inversely, right?
That's the foundational rule of finance at play here. When central banks drop interest rates to zero, the cost of borrowing just vanishes. Companies can take on cheap debt to fuel immense growth, or even just buy back their own stock to artificially inflate the price per share.
And from the investor's side, if a savings account or a government bond pays 0% interest, keeping cash is a guaranteed way to lose to inflation.
Exactly. So capital is forced out of the banks and pushed into riskier assets like the stock market, just to find any yield at all.
But that entire mechanism has completely broken down now.
It has. We're now dealing with sticky, persistent inflation pressures, the massive cost of rewiring global supply chains, and ongoing geopolitical conflicts,
So central banks around the world have been forced to pivot. They have to keep interest rates higher for longer.
which completely changes the game for corporate growth. When money is expensive to borrow, you just can't rely on financial engineering anymore.
Future market returns will actually have to rely on, fundamental business growth,
Yeah.
true innovation, and real profitability.
The companies that survive have to actually produce value, which brings our whole collision into full focus. The broader economy is slowing down due to aging populations, and traditional business operations are way more expensive due to higher interest rates.
Therefore, capitalizing on those few concentrated areas of exponential tech growth, it isn't just some highly aggressive, risky strategy anymore.
No, it is becoming a mathematical necessity just to outpace these macroeconomic headwinds.
So we have a slowing broad economy, but this massive tech boom happening simultaneously. I guess the obvious question is, if these S curves are so powerful, why isn't everyone making an absolute fortune off them right now?
What holds the average investor back? Human psychology, specifically something analysts call the disbelief premium.
The disbelief premium. Okay, unpack that.
Right now, retail investors are incredibly cautious. The media narrative is constantly shifting, sentiment is fragile, and everyone is just waiting on the sidelines for the perfect moment.
They want absolute clarity on how, like, AI regulations will play out, or they want to guarantee that interest rates are finally going to drop.
Exactly. But in financial markets, safety is the most expensive thing you can buy.
I'm going to push back on that a little, though. Isn't it just fundamental human nature to wait until things feel safe? I mean, if we see macroeconomic warning signs flashing everywhere, we're biologically wired to avoid stepping into the unknown. Waiting for the dust to settle just feels like the responsible thing to do.
It is entirely human nature, I agree. But the absolute most critical ingredient for extreme wealth building is disbelief. By the time an investment feels totally safe, by the time the regulatory frameworks are finalized, the use cases are proven, and the winners are universally crowned on the front page of every newspaper.
The prices have already re-rated significantly higher.
Yes, you pay a massive premium for clarity. If you wait until it is obvious, the explosive middle of the S-curve is already completely behind you,
The 10 and 50x gains are totally gone, and you're just left fighting for generic 5% annual returns along with everyone else.
which is exactly why this current decade is a now or never window. To build life-changing wealth, you have to endure the psychological discomfort of uncertainty.
You have to capture the upside of these technologies before institutional dominance makes them mature, slow, and totally predictable.
Exactly.
If you're interested in financial education, investing, and understanding how money works, make sure to subscribe to the channel. We regularly break down complex financial ideas in simple terms. So we've mapped out the collision, the board is fully set. Now, how do we actually play the game? Let's transition into the mechanics of execution and look at three specific exchange-traded fund or ETF strategies designed to ride this technological wave.
Great. But before we detail the specific tickers, there is a non-negotiable prerequisite here.
Oh, okay, lay it on us.
The strategies we're about to discuss are highly concentrated. Therefore, this assumes you already have a foundational broad market fund in place to act as your financial bedrock.
Right, we're talking about a standard S&P 500 index fund, a total U.S. stock market fund, or a total world market fund.
Yes, you absolutely need that diversified core for baseline wealth preservation before you start heavily tilting your portfolio toward these highly disruptive sectors.
You build the concrete foundation first. But once that foundation is poured and secure, how do we build the house to capture these exponential S-curves? What is the first mechanical strategy?
Target number one is broad-based technology exposure, specifically through ETFs like QQQ or QQQM.
Okay, the cues.
Right. These funds mechanically track the NASDAQ 100 index, which is made up of the 100 largest and most innovative non-financial companies listed on the NASDAQ exchange.
So it's essentially the everything tech bucket?
It is, and the
Okay.
mechanics of why it works so well are fascinating. It's a market cap weighted index. That means the larger a company gets, the more of your money goes into it.
It isn't strictly a thematic AI fund, which I guess is its real strength.
Exactly. It captures the massive AI leaders and tech disruptors, the NVIDIAs, Microsofts, and Metas, but it automatically adjusts. If a completely new technology takes over 5 years from now, the fund naturally rebalances to capture those new winners.
It's basically a self-cleansing mechanism. As a company succeeds and grows on the S curve, the ETF automatically allocates more capital to it. And as a legacy company shrinks, it just gets sold off.
Precisely. You capture the massive tech upside without forcing yourself to bet your entire portfolio on one highly specific, narrow theme.
But what if a listener wants to get a bit more targeted? Say they want to focus heavily on the mechanics of the AI revolution and they really want global exposure. What's the play there?
That leads us to the second strategic option, ART-AY. That's the iShares Future AI and Tech ETF.
Oh, anyway.
Okay, and this operates very differently than QQQ. It's much more specialized and is explicitly designed to capture the entire global AI ecosystem, from the physical hardware all the way up to the specialized software and cloud services.
And importantly, it's not just restricted to US companies.
Correct. It actively includes emerging markets. The composition here is key because it goes far beyond the standard household mega cap tech names.
Right, the Mag 7.
Yeah, it looks deeper. The top holdings include vital supply chain companies like Micron, AMG, Marvell, and CoreWeave.
Oh, wow.
And while it's a relatively newer ETF, just due to the sheer novelty of these technologies, it has boasted an average annual return of over 24% over the past 3 years.
I really like to think of Artie as investing in the picks and shovels of the AI gold rush.
Yes, exactly.
Because during a gold rush, the people who consistently made the most money weren't the prospectors digging for gold. It was the people selling the shovels, the pickaxes, and the tents.
That's the perfect way to look at it. With this fund, you aren't just betting on who builds the best consumer AI chatbot. You are investing in the cloud infrastructure, the data storage, and the specific software enablers that make the entire global AI industry even function.
Which brings us to the third and absolute most concentrated strategy, right? SMH, the pure play semiconductor ETF.
Yes. If QQQ is broad tech innovation and ARTI is the global AI ecosystem, SMH is purely the physical hardware backbone.
Semiconductors, the literal physical chips.
Yes. Chip manufacturers and designers like ASML, TSMC, and NVIDIA are the top holdings here. And semiconductors have consistently outperformed other thematic tech ETFs because they are the absolute critical constraint in the entire AI value chain.
Let's dig into the physics of that constraint for a second. Why are semiconductors the ultimate bottleneck?
Because all software is ultimately limited by the physical hardware it runs on. AI models, specifically large language models and generative AI, require processing power that is orders of magnitude higher than traditional linear computing.
You literally cannot build a new data center, you can't train a new model, and you can't deploy AI at scale without these highly advanced chips.
Right, so if you believe that specialized hardware will continue to be the absolute necessity powering all future innovation, SMH gives you direct exposure to that exact bottleneck.
But we need to be very clear about the mechanics of a pure play ETF here, because SMH is at the absolute bottom of the tech supply chain. It is highly sensitive to the broader market.
It is extremely sensitive.
If a massive tech company decides to reduce its capital expenditures next quarter and buy fewer chips, the semiconductor companies feel that pain immediately. It's subject to the bullwhip effect.
That is a very vital warning. A pure play ETF is inherently more volatile. While the upside is tremendous, you have to be psychologically prepared for 30 or 40% drawdowns along the way.
Yeah, you're trading broad stability for concentrated, explosive growth potential.
Exactly.
So let's bring all these threads together. The core takeaway from today's deep dive is that we are crossing a profound transitional threshold right now. The macroeconomic tailwinds of the past, easy money, zero interest rates, and booming demographics, they are fading fast.
Slower overall economic growth is becoming the new baseline reality.
Yet, at the exact same moment, we are experiencing the violent collision of multiple explosive technological S-curves.
It is a truly unique historical moment.
Hmm.
But the goal of understanding this isn't to frantically speculate, don't take out loans to day trade or try to perfectly time the absolute bottom of the market.
Right. The goal is to deploy patient capital into the right, highly concentrated sectors.
You want to let those assets mathematically compound over the next decade before the institutional money fully saturates the space, the S-curves flatten out, and the growth inevitably slows down into predictable, boring maturity.
It is the ultimate window for the everyday investor to capture life changing upside before demographic gravity sets in permanently.
And, it leaves us with a truly provocative thought to mull over. We've all been taught that extreme diversification is the ultimate safety net.
Yeah, diversify, diversify, diversify.
But if extreme market concentration is the new normal, if the physics of technology dictate that a tiny fraction of companies will generate almost all the future wealth in the world, what happens to that traditional advice?
Wow. If the traditional safety net of broad diversification is actually just watering down your exposure to the only 10 companies actively making money, then playing it safe might actually be the most dangerous thing you can do to your portfolio. Thank you for watching this video all the way to the end.
If you enjoyed this discussion, subscribe to the channel, leave a like, and we'll see you in the next breakdown.